Okay, welcome everybody. I'm going to give everyone a minute to get here. And I just wanted to announce that the next week's meeting, I'm going to be out of town on Wednesday. So I'm holding the week 3 meeting on Sunday, 12 o'clock Eastern. Sunday, 12 o'clock Eastern. So just be aware of the fact that I will be holding that meeting at Sunday, 12 o'clock Eastern. Okay? And if, of course, you don't have to be there, you just have to watch the video, and that will provide you with the everything you need, and then just give me the code word. I just wanted you to be aware of that. We'll give it a few minutes, see if anybody, if we get anybody to attend. Hello. Hello, Terry. Hello.
Hi.
Okay. You could mute yourself. Nice to have you here. We'll give it a few more minutes, see if some of the folks are going to attend. Okay, I'll be back in a minute. If you want to open up your if you want to open up your let me share my screen for a minute. Well, it's just you, Tom. Terry, I'm sorry. Uh, you can open up your book too, because I'm going to be using the book to go over bond and debt valuation. But that's up to you, whatever you want. You can also open up your Excel spreadsheet if that helps. So anybody who's even following at home, you can open up your Excel spreadsheet. I'll get started in a minute. The one thing I wanted to point out to everybody is and I mentioned it already once, but for your benefit, Terry, is that for next week, I'm holding the on live session on Sunday at noon Eastern. I can't make it on Wednesday, so I'm going to do it at Sunday at noon Eastern. Obviously, there'll be a recording for everybody to watch it. All right, I'll be back in a minute. Okay, we'll get started. So in this week's work, so far I looked at last week's work. If you haven't gotten it done yet, let's get it in. Some of you haven't submitted yet. It's important that you stay on top of this. We're going to look at the criteria for raising funds, look at the external sources of financing. We're really going to look at debt this week because that's where most of your um, assignments are going to be centered around, calculating bond prices. So I want to get you through that. I mean, growth strategies are important. We've been posting that. That's been part of the discussion. So that's really what we've been handling in the discussion. And I'll get to that in a minute. But bond activity is really what you want to learn about, right? So that's our overview for this week. We're already in week 2. Once again, week 3, I'll hold it on Sunday at 11. But if there's any questions, just let me know. And that's really what you have to do. And you have to keep up on your course project, which is growth and expansion strategies. So let's just take a look at some of this. The growth and expansion strategy. Based on the concept that you learned this week from the assigned videos and articles surrounding growth strategies for companies, make an initial assessment. Now we're going to follow up on Gentry, right? On whether Gentry should expand into China, Japan, and Germany all at one time or in a phased approach. If in your assignment, recall the strategies that you discussed in this module's discussion, questions about the different types of financial investment companies used for growth. Provide your recommendation in a 700-word paper with APA formatting. Once again, you could find information on APA formatting under the course resources, right? Under the resources section. So if you're having any issues with APA formatting, get on top of that. The school provides you with great information on APA formatting, so just stay on top of that, please. And if you have any questions, let me know. Include the advantages and disadvantages of expanding with debt and equity. So it's really the choice between debt and equity. Debt meaning we borrow money, and equity meaning we take on partners and give them shares of the company. Assess and research the steps necessary to expand globally by finding articles in the Rasmussen College Library. And the library has the following pages to help you start your research. And there's the School of Business Guide and the Finance Guide. And to review how to write business reports, here's the FAQ. Submit your completed assignment by following the directions below. And let's take a look. So if you just call this up, I think this should come up. Yeah. And here's your online library. And you just search here. So you could say growth strategies. See what comes up. Just consent. This is EBSCO, which is one of the top business research resource centers. And you got some growth strategies, typology of growth hacking strategies, climate seasonality and growth strategies and creative industries. You're gonna have to, you might have to narrow your search. Like for instance, we may want to say growth strategies in business. And just click on that. Okay, so this is, let's try that again. Growth strategies in business. Can't see it. And here we go, winning strategies for business, business models. So you can just keep business strategy, how to compete in dynamic business environments. And the beauty of the library is you have the full text. You don't even have to go to the library. Back in the day, we had to go to the library. Today, you don't even have to go to the library. It's all there for you. Again, search. Remember, if you use any of this stuff, either summarize it and you put it in your own words and your own take on it, not just your own words, or you need to refer it, put in a reference. And that's all going to be part of APA strategy, okay? This guy's out of the University of Turin in Italy. So I'm going to close that, but hopefully there are no questions on that. So that's one of your assignments this week. And it's due on 5:30. Already on Wednesday. Okay, 100 points. You could put in an unlimited amount of attempts on this. Any questions, just give me a call, give me a holler. All right, and then discussion we've been doing all along. Let's take a look at that. This is different growth strategies. So we have some here by Dave. Good job. Nice reference. Some by Julie, very good. So there you go. Like that Edgar had mentioned that he wants it on live strategy. Play it safe, take the year's treasury rates. Thank you. Edgar brings up hedging. Thank you for bringing up hedging. 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 Strategies. When we hedge, what are we doing? We're cutting off our upside, but we're also lowering our downside. So effectively, if we do it right, we can make sure we have enough cash flow to invest in businesses, right? Because what happens if I don't hedge? Well, I could lose money or I can make a lot of money. But if I lose money, I don't have enough money to keep growing. So I'd rather sometimes cut off some of my upside by hedging. So this way I know that I have the cash flow in the bank. And hedging strategies allow us to maintain capital, because that's what we're talking about today, capital structure. Capital structure and assure cash flow. I'll show you what I mean in a minute. And let's see. See if I can find this for you guys. Oh, thing on hedging. So that's on hedging, and that's the site for hedging. Some bonds, we also have hedging policies. Excellent, excellent, excellent. So we have some good, we're doing some pretty good on the discussion. Now, what does it mean when we hedge? Why do we want to talk about hedging for a minute? Let me call up a spreadsheet. So let's say I'm running an airline, right? Head of an airline. And I know that I have the holiday season coming up or the summer season. People travel. Let's forget that we're in the middle of COVID. Let's talk about normal times, which hopefully we'll be back to it soon enough. And I know that if the price of and I'm going to use the price of gasoline because you fuel a plane with airplane fuel, right? But let's use the price of gasoline because that'll make it more relatable. So let's say gas is right now $2.75. And I know that if I hedge my $2.74, in other words, if I get into a contract that buys the gas today at 2.75, I'm assured of knowing what I'm going to have in revenue, X amount of profits, say $5 million of profits. So now I know if I put that hedge on, I know I have $5 million in the bank, right? Because I'm pretty sure that I know I already sold the tickets to the seats, and my biggest cost, my labor costs are locked in. So now my biggest cost is the hedge, and by employing that hedge, I've locked in my profit. Okay, so I go ahead and put the hedge on. Now, if I didn't hedge and the price of gasoline goes up to $3.25, I wipe out my profit. I can lose money, and above that, I start losing money. If it goes down to 2.25, I could double my profits. But what's the risk of doing that? Well, yes, it's great to double your profits. You don't want to, but if it goes the other way against me, not only do I have now possible bankruptcy costs because I can't pay my bills and I can't pay um my debt, right? I have debt outstanding. But the second thing is I won't have cash flow to invest in new businesses. So by hedging, I've cut off my potential upside, but I've also reduced my downside risk. And I've given myself the ability to continue to make payments. That makes sense. So that's why we like to hedge. That's why we want to use hedging as a device for assuring that we have cash flows and mitigating our business disruption costs. And what are business disruption costs? Well, those are the costs of not paying our bills, bankruptcy costs, the potential of having bankruptcy costs. So these are things we definitely want to avoid, okay? So any questions on that? Any questions on that? So let's go back to this week's work, and we're going to talk about the bond market. So I've opened up the bookshelf, and what do we talk about when we talk about bonds? What do we talk about when we use debt to finance assets? We take on debt to finance our operations, just like individuals borrow from commercial banks, and they also borrow when they sell debt in the public bond. So basically what debt is, it's an IOU. We're borrowing money and we're giving the investing public an IOU that we're going to pay them back. And generally speaking, bonds pay interest every 6 months, right? It has a time value of money. They pay interest every 6 months. And at the end of the term, if it's a 5-year bond, you get your money back. And most of it revolves around time value of money. Most of it revolves around time value of money. So we can borrow money privately from banks, right? We can make private placements. That gives us speed because we can do it quickly. Sometimes it reduces our costs and it gives us some flexibility if we go right to a bank. The problem when you go to a bank is you can't, the securities don't have liquidity. You don't have a security in the public market that trades and offers liquidity. And that's the problem with private debt placements. Even though they're quick and it's like going to the bank for a loan, now it's hard to, like, say, have liquidity where other people will buy these securities and trade them, which allows you to borrow even more money because liquidity is a key, right? And generally speaking, interest costs are higher when you go directly to the bank. And the bank is going to put more covenants on you, which means they're going to put more limitations on what you can do since you borrowed the money. They may say, well, you have to stay within this business, or that you can't have debt, short-term debt that's so big. So they could put a lot of limitations on it. So that's one of the features of going to a bank. Another thing you could do is a floating rate loan, right? A floating rate loan is when the interest rate floats, much like when you have a floating rate mortgage. So just so you know, the bank could offer you that because what they'll do is they'll use something like LIBOR, which is like the Fed funds rate or prime rate, and every month or every so often, maybe every year, they'll adjust your payment just like they do with a mortgage. So that's all a floating rate is. Some companies want that because they don't want to be in high interest rate environments. They'll want a floating rate loan because they don't want to lock the money up where they owe like a high interest rate and they're hoping that the rates go down. So they'll take a chance that the floating rate loan will work in their favor. In times like this, you generally don't want a floating rate loan because rates are so low, you really can't benefit by much. Okay. And when we look at the spread between whatever the benchmark is, in this case, they're going to use a rate that they call the benchmark. LIBOR is like our version of the Fed funds rate, right? It's the rate where banks trade with one another. You do it in basis points. So what's a basis point? Each percent has 100 basis points. That's what a basis point is. They basically took 1% of interest and they divided it by 100 times. And so 1/100th of a percent is 1 basis point. So basically, if you borrowed money at 4.5%, you could also express it at 450 basis points. Or if your loan was 200 basis points over LIBOR and LIBOR is at 4%, well, 4% plus 200 basis points, which would be 2%, equals 6%. So you'd be borrowing money at 6%. Okay, but we look at it in basis points because that's how we calculate the daily changes in your loan. Some kind of loans, some types of loans are working capital loans. Some type of loans are transaction loans. This is working capital loans where we just use the money, make sure we have enough working capital. If we have a secured debt loan, that means we've secured it against assets. It could be our planes, it could be equipment, it could be buildings. Those are secured loans. You are putting up collateral. When you borrow money to buy a car, it's a secured loan. When you borrow money to buy a house, it's a secured loan because you've secured it with your house or the car. You put that up as collateral. When you take money in a credit card, that's an unsecured loan because you haven't put anything up. That's why the rates are so high for credit cards. So hopefully that gives you a good view. Now, when you go to the public markets, you go to a firm, and they put together what they call a syndicate, which are different other firms that will help you sell your bonds. They'll review your balance sheet and they'll put together a plan for you and say, well, the best thing for you right now is to borrow money for 10 years at 3%. And then they'll take you out and let you present your company to different investors. And who buys these bonds? The public bonds, like say Coca-Cola floats a bond or IBM floats a bond. The public investors will be paid places like Fidelity or Vanguard, or the big firms that are investing your money in mutual funds. They'll source these bonds by buying them in directly from the big banks. So that's who buys a bond. And a bond is basically an IOU. So it in this case, they give you an example of a loan agreement that's 0.25% or 25 basis points over LIBOR, and they're giving you different LIBOR, and they're showing you the amount that you'll spread. So they're just adding 25 basis points, giving you the loan. So now let's get to the nitty gritty. What is a bond like? Well, the first thing we have to look at is the bond indenture. And the bond indenture is basically the contract. It's a contract. It's the contract between the bondholder who owns the bond, who lent money to the company or to the treasury. People, the United States government sells bonds, corporations sell bonds, municipalities sell bonds. The bond indenture is basically an agreement between the lender and the person who bought the bonds, the loaner. The loan, what is it? The lender is the person who lends the money. The person who borrows money is the borrower. The indenture is the agreement between the borrower and the lender, and it basically states things that the company can and cannot do. So, for instance, if you're running Coca-Cola, you can't turn it into a biotech company. Or if you're running IBM, you just can't all of a sudden now take on tons of debt. That diminishes all the debt holders. There's limits to what you can do, and those are called covenants. Those are called covenants. So you have the indenture. Par value is the general value of the loan, which is of each particular. So if you sold $100 million worth of bonds, you sell them in $1,000 pieces. Even if you sold $1 million worth of bonds, you would sell $1,000 bonds. Every bond has a $1,000 value, and that's called par value. So the way it's expressed is not in a thousand, but we express it in a percent of 1,000. So when we say par, we say 100, but 100 really means 1,000. So take your time, read through this so you understand how the bond market works. Maturity is the date that the bond expires. So if you have a 10-year bond, say and you floated it today, it would come due on 5/26/2031. That's when you would get your money back. So that's what the maturity of a bond is. The coupon interest rate is how much the bond pays. The current rate is it's a simple calculation. It's whatever the bond pays versus the current market price of the bond. So in this case, the market price of the bond is 700. The interest is 8%. So we would just put 80 over 700, and that would give us the current yield. That's just simple interest over the price of the bond. But to actually know the yield to maturity, you have to do more, and how much you're making given time value of money, you have to do the calculation. What's a call provision? Well, just like in a mortgage where you could pay the mortgage off early, some bonds come with call provision, which allows the company to pay off the bond early. And what they do is they'll pay you a little bit more, but they'll take it in. So say they floated the original bonds at 7% for 10 years, and in year 5, those same bonds could now borrow money at 5%. So they don't want to pay 7%. So they have an option maybe in year 5 to give you back your money plus say $50 a bond, 105, and they could refinance. So really what a call provision is it's the ability for a company to refinance, and generally speaking, they have to give you extra money if they want to refinance. So they'll have like a call schedule. One of the ways that really now I don't know how much of you, so we talked about par value. I'm going to talk about clean and dirty in a minute. One of the things that has really revolutionized the bond market was Bloomberg, right? Bloomberg was a guy named Mike Bloomberg, who I actually knew in my last life. And well, I'm actually my boss. The family I work for was friendly with him. And he came up with this great idea and made a fortune, which was the Bloomberg terminal. So the beauty of the Bloomberg terminal, they are like $1,000 a month. So you wouldn't, you would only buy it if you were a professional trader, but or you were running a trading desk. But it gives you all information on bonds. It gives you information on every asset class. But the beauty of it is it gives you a lot of information on bonds. So like if you look at the bond screen on Bloomberg, it's going to look something like this. It's going to give you, let's see if I can find this. Here it is. So you're going to call up a bond on Bloomberg. And if you ever have access to a Bloomberg anywhere, I don't know at Rasmussen if they have any I know everyone's taking it mostly remote, but this is really a great resource if you want to get into professional trading. Then you could see all the rates, and then you can click further rates, so you can see what the different rates are in different countries, and then you could find an actual bond. This would be a General Motors bond. It's a global bond. There's a 2.75% coupon. There's the ratings, and the ratings are basically like a credit rating. It's like when you have your own credit rating. It tells the public how good the credit is for this company. So like just like you have a credit rating, there's credit agencies like Moody's and Standard and Poor's, and they will rate a company. So they're triple B, this is a triple B, it's almost $1 billion. And then there's all the statistics on the bonds, but gives you the yield. Gives you the yield. So let's take a look at this bond. It's a 2.75% bond, right? And you can actually play with this and put different prices in and see what the yield is. But let's see how you would actually calculate a bond, and this will help you when you do your project. So it's a 2.75% bond. So right off the bat, we're going to put $1,000 in here. That's what the bond is worth. So we'll call it bond price, and they always trade a $1,000 value. we're gonna go bond par price. Okay. Put 1,000 in there. And then we're gonna put coupon in. And the coupon was, if you recall, was 2.75%. So we're gonna go 0.0275. Always in Excel, either put in a percentage sign or express it in terms of 0.0275. Do it either way. So what's our coupon? We're gonna treat this as an annual coupon, but remember, you get paid every 6 months in most cases. But we're gonna do this as an annual coupon. So that times that, that's our coupon. And what's the maturity? We're gonna call it a 10-year bond. Okay? That's a 10-year. So what's the value today? All right, well, let's take a look at the value, the value of the coupon. So remember what I'm doing here so you can do it at home. The key word for this week, bond. Bond is the key word. Bond, B-O-N-D is the key word for this week. And also, Sunday, 12 p.m. Eastern is our next meeting because I can't do it on Wednesday. Then we'll go back to the regular schedule, Wednesdays. Okay, so the coupon, how do I value the coupon? I go to formulas, financial, present value, and I'm going to use the same rate, right? So the rate's going to be 0.0275. The number of periods is going to be 10. The payment is going to be $27.50. Payment's going to be $27.50. Oh, I have to sell, I'm sorry, I have to sell for present value. So we're going to sell for present value. So I'll go back, go to present value. We're solving for present value because we want to know what the bond will be worth today. So the rate is that. The periods are that. The payment is that. Future value is that. And we get the coupon today is worth $237.60, which is, so let's see what the principal piece is worth. Okay. So we're going to go back to formulas, financial, recently used, present value. So the rate is that. The number of periods is that. Payment is put 0 because we already accounted for the payment. And the future value is 1,000. We get 762.40. And now let's sum these up. Notice it comes up negative because I use positives. And if you use positives in one, you're going to get negatives somewhere else. If you use negatives in one, you're going to get positives somewhere else. So that's why I'm getting negatives. $1,000. So why is it worth $1,000? Because my discount rate was 0.0275. So really, all I did was created a spreadsheet that tells me that it should be worth $1,000 today. There's been no change in the rate. Let's put a rate here. Let's try it with a rate now. So we're going to use the rate of 0.02. We're going to create our own little bond calculator, which I want you to use. So instead of using the rate of B5, we're going to make it B7. I'm going to use the rate function. This little rate. Sound start again. So let's try it this way. This is really important that you understand this. So we're going to go to present value again. The rate is going to be 0.0275. Number of periods is going to be 10. Payment is going to be 27.5. Of course, the future value is going to be 0. So we're going to get 237.60, same thing. And now we're going to do it on the present value. Bear with me. I'm going to use B7 now instead. And again, we got $1,000. But what happens if rates go up? What happens if rates go up in our bond deal? What happens if rates go to 5%? Well, we know that if I bought the bond, the coupons aren't going to adjust, all right? I'm going to keep getting these coupons. So if I want to sell this bond in the open market, why would somebody buy it from me? Why would somebody buy it from me if they can get a better rate? I'm getting 2.75%, but the rest of the world say is getting 5%. Why would you buy it from me at $1,000 if you're getting 5%? So let's put 5% in it. Now the market has changed. Rates have gone up. So let's put in 0.05. So I'm going to plug in 0.05. Hopefully following what I'm doing. I'll put this bond calculator in the notes. But notice what happens now. The value of the bond goes to 826. Because the new buyer is going to pay 826, collect the same coupons, but at the end of year 10 get $1,000. The difference between 1,000 and 826 will get them a yield of 5%. Now, I've been carrying this bond at 2.75%. What happens if, like now, during this current period, the rates go to 1%? Well, obviously, I got a more valuable bond, right? I've loaned money at 5%, and the bond is worth now, and the rest of the market's only getting 1%. So what if I wanted to sell my bond? What happens to my bond? It goes up in value because I get the additional benefit today, which makes up for the 1.75% difference. The new buyer, by paying 1,165, gets a 1% yield. That's why when rates go up, bond prices come down, and when rates go down, bond prices go up. Let's save this. Pull up bond calculator. Calculator. Oh, I just want to put it in Rasmussen. There's our bond calculator. Okay, there's our bond calculator. So there you go. So one thing you want to remember is bonds pay every 6 months. I'll put this bond calculator in our notes today. But bonds pay every 6 months. So how do we adjust for that? Just so you know, I'm going to put coupon here, and I'm going to put principal here. I'm going to put value here, and I'm going to call this 6 month. So how do we adjust for that? It's not that hard. We go to formulas, we go to present value, and the rate will, of course, we'll continue to use 1%, but we're going to divide by 2. And then the number of periods, we're going to use 10, but we're going to multiply by 2. And that's what you do differently. And the payment will stay as 2750 divided by 2. I get a slightly different price there. That's how I did it. I divided the rate by 2. I multiplied the payments. I've divided the payments by 2. I multiplied the periods by 2. I divided the payment by 2. And let's do the principal now. I use it. So the rate again is this divided by 2. Rate is divided by 2. Uh-oh. Too few words. It's very, let's close that. Let's do this again. Go to recently used, or you can look. I found all these things under the financial fund. So I go to rates divided by 2. I go to number of periods, which is 10 times 2 I go to payment. I don't have a payment yet. I'm using future value. Put the future value of 1,000. Oh yeah. So let's get that. I'm sorry. So I had to take the last one. You don't divide the principal by 2 because it's one payment. Oh. You don't divide the principal by 2 because it's one payment. So we'll just make it be 3. And let's sum it up. Now remember, you don't divide the principal by 2. It's the only thing you don't do because it's one payment. The other ones did to get divided by 2. And notice we get the same price, just a little different because it's semi-annual. So you get a little bit more value because you're getting interest on interest every 6 months. That's the compounding interest. So yeah, I gave you a little bonus here. I showed you how compounding works. Any questions? Terry, any questions? Any questions? Terry? Okay. Now notice if I go back up to 0.05%, and if I stay with 0.023, 0.0275, I get $1,000 back. And that's our bond calculator. Okay. Simple. Simple. You could solve for any variable if you have all 5 variables, right? So I'm going to call it formula and present value. If I have rate, number of periods, and future value, and present value, I can solve for rate. Right? I can solve for rate. I can solve for any variable if I have the other 4 variables. Right? I can solve for any variable if I have the other 4 variables. So what do I mean by that? Let's do a little time value of money. And by the way, you can go to so we use this. You can go to and it's in I have all the information in in the class shell. But always remember, you can go to my channel, go to playlists, go to Finance Academy, and when you get to Finance Academy, time value of money using Excel. You can we go over how we could solve for bond prices. We're basically doing the same thing by watching the time value of money using Excel. All right, we're already up to 40 minutes, and I know we have a time limit here, so I'm going to jump back to the text. Okay, so what's clean and dirty price? Well, when you buy the bond, the accrued interest is separate. So in other words, if the interest pays every 6 months and you sell the bond in 3 months, you've effectively earned 3 months of interest. So how do you get that money back? Well, you trade the bond based on the amount of whatever the present value is, and the buyer of the bond gives you the 3 months interest in a separate part of the invoice, and then they collect 6 months. So you get your 3, they get the 6 at the end. So effectively, if this bond was trading at say 0.02% yield, they'd give you 1,067, and if it was 3 months of interest, well, let's do 3 months. So it would be 1/4 of a year, right? I'm gonna make this easy. So we take our coupon times, let's do our accrued. Let's do a little quick accrued calculation. So accrued would be full time. So if it's 0.25 of a year, and we have a coupon of 27.50, so we would say 27.50 times 0.25 of a year. The accrued would be 6.875. So the buyer would pay 1,067, and in a separate transaction, give you $6.87.5. At the end of the 6 months, they would collect the full coupon of 27.5 divided by 2, whatever that is, 12 or $13 and change. So that's how accrued works. That's how accrued works. Okay. So it's 2 separate transactions. So they call so how do they express that in finance? Um, the clean price is the price before you consider the accrued interest. The dirty price has the accrued interest in it. But the price you'll see trading is the clean price. The accrued takes place in a separate transaction. We talked about adjustable rate mortgages. We talked about call provisions. We talked about ratings. And let's look at some key relationships in bond trading that we just went over, but I want to go over them one more time. The value of a bond is inversely related to change in yield, right? Which is one. Now, this is a lot of calculations that I just did for you on the Excel spreadsheet. That's all this is. What the Excel spreadsheet did was reduce these calculations to they did it for you. So basically, what it says is when rates go up, bond prices go down. And when rates go down, bond prices go up. Why does that happen? Well, we saw that happen in the bond calculator. Let's say rates go to 10%, the bond prices are going to go down to 500. So you see the dramatic move in bond prices. But if they say at the same price, and keep in mind that as time goes on, the bond trades and the maturity changes. Like for instance, you're looking at it the day that it was issued. But if it happens a year from now, we're looking at a 9-year bond now. And we would turn this number into 9. And that would change. It would still be the same because it's 2.0275. But it would also change, say if we go to a 5% yield, it would now go to 840, where when it was 10, it was 826, because now you have a shorter bond, so it does the time value of money versus a shorter bond. So remember that there's a lot of moving pieces here. As every day advances, the maturity changes, the coupon stays the same, obviously, but rates and maturity change, and accrued interest changes every day, because every day when you collect a little more money, the accrued changes. Okay. Notice all this stuff gets calculated for you on the Bloomberg spreadsheet. That's why people love the Bloomberg, because it's all done for you. Look, the accrued is right there. On a $1,000 bond, it shows you exactly what the invoice would be. So it's pretty cool. That's why I put it in. That's why Bloomberg charges all that money. And you can see that market value of bonds and required rates of return, how the bond starts to go down. Longer bonds are more sensitive to interest rates than shorter bonds because you're waiting more for your money, time value of money, right? Higher yielding bonds are more sensitive than lower yielding. The market value of a bond will be less than its par value if the market's required yield is above the coupon interest rate. So again, if rates are above the interest rate, the market value of the bond will be less. And it'll be more if it's below the interest rate. So we just showed you that. Market value of the bond of the yield is less, you're going to get a higher payout. As the maturity date approaches, the market value of the bond approaches its par value. That should make sense to you now, right? As time goes on and we get closer and closer to the date, and then on the last day, it's basically going to trade at par. It truncates. So even if you had a bigger value, as you come to the end, you're going to go down to par. And if you have less, you're going to go up to par. So as it approaches the life of the bond, it's going to trade at par. Notice if I put in 0.01, which is like a day, like a tiny amount of time left, look how much closer we are to par, even at a 5% yield. Because all you have left is the 1 day. So all the discounting doesn't matter anymore. Is essentially what we're talking about. As opposed to a 10-year bond. Interesting, right? Very interesting. Okay. Longer term bonds have greater interest rate risk than shorter term bonds. So again, a maturity of 10 years has this kind of rate risk, right? Maturity of only 1 year has little interest rate risk. Doesn't move that much because you're going to be getting your money back in a year. It's just intuition. Remember, the keyword is bond this week. Okay, and what determines interest rates? We'll kind of wrap it up here. What determines interest rates? Really, there are a couple of things that determine interest rates. Inflation is one thing. Fisher effect, the relationship of nominal interest rates is what we ever we anticipate in inflation and the real interest rate. The real interest rate is what we would really charge somebody. It's what you want to get for the risk of the company. So say IBM has a 2%, everybody wants 2% from IBM no matter what. The government, by the way, charges the least amount, gets charged the least amount of interest because they consider it the safest investment. You know, the US government's the safest investment. So you got 2% and then whatever you think inflation is going to be. So if you think inflation is going to be 2% and the real rate's 2%, you'd be paying a nominal rate of 4%, which is your real rate plus inflation. Always add inflation to the real rate. Okay. There's a nominal rate, 1.05. If you divide it by the inflation rate, take the nominal rate divided by the inflation rate, you get the real rate. Okay. So nominal, so in real plus inflation is nominal. 1 plus the nominal divided by the inflation rate minus 1 is the real rate of interest. Any questions? So you have a nominal rate, you have the real risk-free rate of bonds, an inflation premium, a default risk premium that the company goes out of business. For length, you're going to pay more. The longer the bond, the more you pay. And liquidity is also another factor. The more liquid the bond, right? The shorter bonds are more liquid. The longer bonds are less liquid because there's less people who want to borrow and trade in the longer markets. You pay a premium for that. To be short, you're going to pay a premium. To be long, to be long, you're going to pay a premium. To be short, you don't get as much a premium. So you have liquidity risk, maturity risk, default risk, and an inflation premium. I just want to highlight that. Okay. And could also, so you got your real rate plus your inflation rate equals the real rate plus the inflation rate plus the real times the inflation, which is 5.57%. That's the Fisher effect. So you take your real rate plus your inflation rate minus your real rate, one plus your real rate times 1 plus your inflation rate minus 1, 5.57%. So those are all your premiums. So yeah. Yeah, this in the notes. Okay, and that should basically cover our chapter this week. The yield curve is an expression of the interest rates and time to maturity. Where can I find the yield curve? You could find it in the Wall Street Journal website. Go to, and I can't stress enough how much I want you to use the Wall Street Journal website. Go to markets. Change this. Let's go back. It's go to bonds. It's the yield curve in tabular form. Okay, so you're seeing the yield curve. There's the different government bonds. There's the yield curve in tabular form. But what the yield curve would look like if you want to actually look at it as a curve. Would look like this. And generally speaking, the yield curve slopes upward because rates generally tend upward because of longer maturities and the liquidity premium or the uncertainty of inflation. Whenever you get a downward sloping yield curve, that may be in a period where you're in a very hyperinflation period and people expect inflation to go down in the long term. But generally speaking, you have either an upward sloping yield curve or a flat yield curve. And that wraps it up today. Any questions? Once again, let's see. No, good. Once again, I will be here on 12 o'clock Eastern on Sunday. The code word is bond. It was great having you aboard today. I hope you learned a lot, and thank you for attending. Terry, goodbye. Thank you for attending.